Hi, I'm Chelsea from Bezla. Concentrating your hotel investments solely within one region or country leaves you vulnerable to localized economic downturns, political instability, natural disasters, and even shifts in local tourism trends. Geographic diversification acts as a buffer, mitigating these risks and potentially enhancing overall portfolio stability and returns. The core principle behind geographic diversification is simple. Don't put all your eggs in one basket. By investing in hotels located in different regions and countries, you spread your risk exposure. A severe recession in one country might impact revenue for the hotels located there, but the impact is lessened by the presence of other properties in healthier economies. Similarly, if a natural disaster strikes a coastal city, hotels inland remain unaffected. Merchants spread their cargo across multiple ships to avoid complete loss from piracy or shipwrecks. This is a rudimentary form of geographic diversification. Consider the 2008 financial crisis. Hotels heavily concentrated in the United States experienced a dramatic drop in occupancy rates and revenue per available room. However, hotel companies with a significant presence in emerging markets such as Asia and Latin America fared relatively better as these regions were less severely impacted by the crisis. Similarly, the COVID-19 pandemic provided a stark lesson in the importance of geographic diversification. Regions with strict lockdowns and travel restrictions saw hotel occupancy plummet, while areas with more lenient measures experienced a less severe decline. Hotel companies with a global footprint were able to offset some of the losses in heavily affected areas with revenue from regions that were recovering more quickly. Geographic diversification isn't just about mitigating risks. It can also unlock opportunities for higher returns. Exposure to rapidly growing economies and emerging tourism markets can significantly boost portfolio performance. For example, investing in hotels in Southeast Asian countries with burgeoning middle classes and increasing tourist arrivals could yield substantial returns compared to investing solely in mature, saturated markets. Choosing the right geographic locations for hotel investments is a critical decision. It requires careful analysis and a deep understanding of various factors that can influence the performance of your properties. Here are some key considerations. Economic growth. Look for regions with strong and sustainable economic growth. A healthy economy generally translates to increased business and leisure travel, boosting hotel occupancy and revenue. Analyze GDP growth rates, employment figures, and consumer spending trends. Tourism trends. Identify regions with growing tourism industries. Consider factors such as international tourist arrivals, domestic tourism, and the development of new tourist attractions. Analyze tourism trends specific to different market segments. Political stability. Political instability can deter tourists and investors, negatively impacting hotel performance. Assess the political climate, government policies, and the risk of social unrest. Look for countries with stable governments, predictable regulations, and a strong rule of law. Infrastructure. Adequate infrastructure is essential for a thriving tourism industry. Evaluate the quality of transportation networks, airports, roads, railways, communication infrastructure, and utilities. Easy accessibility and reliable services are crucial for attracting guests. Regulatory environment. Understand the regulatory environment in each target location. Consider factors such as business licensing requirements, labor laws, taxation policies, and environmental regulations. A favorable regulatory environment can reduce operating costs and simplify business operations. Currency risk. Investing in foreign countries exposes you to currency risk. Fluctuations in exchange rates can impact the value of your investments and your returns. Understand the currency dynamics of each target market and consider hedging strategies to mitigate currency risk. And cultural nuances. Different cultures have different expectations and preferences when it comes to hospitality. Understanding these cultural nuances is essential for providing excellent service and creating a positive guest experience. Consider factors such as language, customs, and traditions. If Bezla could be a service for your hotel marketing, call us at 888-999-8086 or visit us at bezla.com.